Folks, Bob Desmond over at the Contrarian Trader, and welcome to Stock Trading Tip number 1, exclusively for Facebook. So the title of Stock Trading Tip number 1 is, why do banks issue upgrades and downgrades? Think about it. You get all this free advice from banks when you turn on CNBC and Bloomberg. Free advice. Wow, upgrade a stock, sell a stock. Why do I get this free information? Banks do nothing for free. They charge you a fee for everything. Well, let's go to the bare basics of what banks do nowadays, particularly investment banks and brokerages. Once upon a time, investment banks made the majority of their money on mergers and acquisitions. Big money too. Fast forward to today, and the vast majority of their profits are derived from trading. So if they have the ability to move a stock by simply calling up CNBC or issuing a press release stating that they're downgrading or upgrading the stock and it's for free, why not do it if you can profit from it? And I'm going to go into an example on the charts in a moment. And you may be asking yourself, why do they issue these upgrades and downgrades? What is their goal? Well, you need to remember that banks and brokers view the average investment as quote unquote dumb money. I didn't make this up. That's what they call the average investor. They have no respect. So what their goal is to get you excited about a stock that's been upgraded, or if a stock has been downgraded, they want to get you afraid to be long of it. If you own it, they want you to sell it. The question you need to ask yourself is why? Why are they giving me free advice? And my tagline, my brand tagline is this: trade the chart and not the story. And I'm going to tell you a story about a recent call by Goldman Sachs on not even a sell call on gold. They said to short it, which is a huge call. Very, very risky bet. I'm going to go into the charts and tell you how I knew they were full of it. And I'm going to speculate, because I have no evidence, speculate as to why they made their call. Let's go to the charts. Okay, so on February the 15th, 2016, Goldman Sachs and their analysts Jeffrey Curry and Max Layton issued just simply a sell. They said short gold. And their call is that gold will slump to 1,100 an ounce over the next 3 months, 1,000 an ounce over the next 12 months. And since gold is a safe haven play, they even quoted Franklin Delano Roosevelt, nothing to fear but fear itself. I'll change that for them. Nothing to fear but Goldman itself. Because now we're going to take a look at the charts and see just how bad their call was. Let's take a look. All right, so what you're looking at right now is a monthly call on gold. And what I put out to the public was my 2016, the year ahead forecast, where I was extremely bullish on gold and the gold mining names, as well as silver, platinum, uranium. So gold here, monthly chart, you could see that we had broken out in February of 2016, prior to the Goldman Sachs call, out of this huge pennant formation. And when you see a breakout like this on a monthly chart, this is not simply a short-term breakout. This is the beginning of a new bull market on gold. And when you take a look at the weekly chart of gold, the week prior to their announcement, gold had already broken through not just one, not just two, but 3 resistance levels. That's a huge feat. The following week, when gold was downgraded to a sell, a short by Goldman Sachs, the shares pulled back, but they held support. And this is what I discussed with members, is that we are going to remain bullish on gold because we're aware of the monthly breakout. We are aware of the weekly breakout, that they are both too strong to be knocked off simply because Goldman Sachs issues a downgrade. And I speculated, daily chart now, I speculated as to why Goldman did what they did. And this is pure speculation. Were I Goldman Sachs and I had the power to do what I did, I would have been watching the chart and identified that on February the 11th, the share price had hit overbought levels as the shares were leaning into the third standard deviation Bollinger Band and very overbought on RSI. At that point in time, were I Goldman Sachs, I would have bought a tremendous amount of put options in advance of my downgrade and short call on gold. And then on the day where they issued their downgrade, I would have sold those puts for a huge profit, bought gold, and went long. And if you had done so, it would have been a sweet trade. We did this with the gold mining names. The gold mining names traded in correlation with gold. So while gold pulled back, we began rebuilding our long position in the gold mining names in anticipation of a rally. So here you have the timeline of events. February 11th, gold goes overbought, extreme overbought. February 16th, Goldman issues a short call on gold. The very next day, the 17th of February, gold stabilizes and then begins to rally higher, thus negating Goldman Sachs' call on gold. Now, if you were to have listened to Goldman Sachs and shorted gold on this pullback, you would have been sitting with a massive loss. And in fact, as recently as last Friday, the last trading day before I made this recording, we put in a new intraday high on the year, while Goldman Sachs says sell short gold. So this is why we can never listen to the headline. We can never listen to the media, which tries to influence our decision making. What you want to learn how to do is learn how to read the charts. And by doing so, you become a very powerful trader, and then you're able to accumulate wealth without having to listen to the so-called talking head pundit experts on CNBC and Bloomberg. And folks, this is the end of this video. So if you like these videos, please enter your email address. We'll have them sent to your inbox. Please share this video with your friends on Facebook and give me a like if you would. Everybody have a profitable trading week, and I'll talk to you soon.